Copper just continues to go through the roof at this point for all these reasons that I've talked about. Silver's going to play along, okay? And that's this whole spread between Shanghai and COMEX is going to continue to widen, and it's going to force the price higher. And so I tell everybody all this just so that as further argument that even though price for silver is at 11-year highs, it's probably going higher.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 27th through June 3rd, 2024, while supplies last. First, we feature 2023 1-ounce Gold Britannia at just $59 over spot. We also have backdated silver 1-ounce Kangaroos at $3.10 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We are always delighted to have this good friend, Craig Hemke, the founder of the TF Metals Report, joins us this Tuesday, May 28th, 2024. Craig, thanks for coming back on Liberty and Finance.
TF and DK. How about that?
You introduced yourself in person to me, and most people may not have heard this, in line for the cook-to-order breakfast at the Embassy Suites in Las Vegas, Nevada, where we were there attending the second Liberty Mastermind Symposium, where you and also my son Elijah were speakers. And it was great to get to meet you in person, and we've continued to appreciate the wit and wisdom that you shared with us over the years. And I think our viewers have come to recognize you as a straight shooter. Right now, there's a lot to talk about. We've got an exciting springtime that it's been for the precious metals market. Gold breaking out to new nominal all-time highs against the U.S. dollar. Silver showing remarkable signs of life, breaking several resistance tries that it had done in the past at 30 and now seeming to hold its head up above that level. And there's been a lot of talk about scarcity of available silver on the major exchanges, both the COMEX and the LBMA. And the most recent interesting development is major bullion banks, including like Deutsche Bank and HSBC and JP Morgan, showing up, having discussions with the Shanghai Exchange saying, hey, well, we don't know what they're talking about, but it's very interesting that at the same time that their shorts are in a bundle because of their naked shorting position, the concentrated position on the COMEX, and in the face of dwindling physical supply, that they'd be over there chatting with an exchange which is running about $4 per ounce higher on silver than seen in the West. So we'd like to hear your thoughts on all of that, and we need to talk about gold. And frankly, our viewers are also interested in copper. We'll get around to that because copper, as they call it, Dr. Copper, seems to be often an indicator of which way the macroeconomy may be trending. And people are wondering, are we heading into we've been told for quite some time from mining executives is a desperate shortfall of available copper that's necessary for industry. Or what's going to be happening. So maybe we could rewind this discussion and talk about what's on a lot of people's minds, and that's what's going on with silver, and get your take on that.
Well, it's been quite an interesting year so far, that's for sure. We began the year at kind of a peak optimism in terms of rate cut expectations, and the dollar index was down to 101, and all of that seemed to be a little too aggressive, given where we were economically. So as the year started, you had to figure, okay, at least the first couple of months are going to be kind of tough for gold and silver, and they were kind of tough. I mean, gold and silver both going down for maybe till about Valentine's Day. And then gold started to perk up. It actually then formally broke out of about a 3.5-year price range back on Friday, the 1st of March, rallied $100 the next week on, just people being enthusiastic and seeing that breakout. And then, we're up another couple $100 from there. again, in the face of dwindling rate cut expectations and a rising dollar. So that was all, caught even me. I was caught kind of flat-footed by that too. I was expecting, maybe this happened by summertime, as it's pretty clear the economy is slowing, but instead it takes off. Silver waited about a month, was watching what gold was doing, and then said, okay, I want to play along too. And so on April the 1st, silver took off. And now here we are 8 weeks later, and it's gone from about 24.50 up to 32. So what's that, 30 some odd percent? It too has now broken out of that about 4-year trading range, and that's gotten a lot of people's attention. That the tough thing I shouldn't say tough thing. The challenge to remember is that even though the pricing ability is demonstrably shifting east, it hasn't fully shifted there yet. And as long as the derivative and the paper markets are still playing a role in London and in New York, you're always going to move up in stages. So yes, it's great. Silver's broken out. Yes, it's fantastic. It's $32 an ounce, but that does not mean it's going to be $62 an ounce by the 4th of July. Okay. That's not how it works, man. And you mentioned part of that. Then again, you get you get rally, get people come in, and then price kind of rolls over, and then it kind of flushes back out and then pulls back, and then it's ready to move up again. And that's just kind of the ebb and the flow of how price is discovered when you trade derivatives to do that. And so we should still continue going higher from here, but it's this, not straight up like some people would hope.
Yeah, that phenomenon, could you maybe talk about one aspect of that? And there's been this wash, rinse, and repeat cycle that people have described for decades where the bullion banks versus the speculators and so on on the COMEX, where when there's an overbought condition, then you'll see these dramatic hits of, the COMEX will open at whatever, 8, 9 a.m. Friday morning, and you see this. It's been valiantly rising, jaggedy line all weekend and all night, and then in the early hours of the morning, then suddenly, boom, it gets hit with, sometimes it's like more than a year's worth of production of silver contracts bet against the market, and it slams the price down in what appears to be a rather unnatural market move compared to during the time that the COMEX wasn't open. Is that the kind of thing that can still happen, even if the major bullion banks are caught in a short position here against a rising overall silver market? They've proven in the past, at least, the ability to continue to make profitable trades by doubling down and sort of kicking the snowball downhill until it gets some momentum, and then reversing and covering their short position, at least partially, and keeping to make profitable trades along the way. Do you see that a realistic potential, even though they may be holding the most concentrated short position perhaps in the history of the market?
Absolutely. And you can, there's these ideas that are, some people say, are opposed to each other. Somehow they're mutually exclusive, but they're not. The bullion banks can manage and manipulate the price of the precious metals to certain price targets almost on a daily basis. But that doesn't mean price can't go up. I mean, that evidence is right staring you in the face, right? Gold's gone from $400 to $2,400 in the last 20 years. But the bullion banks, there's still a JP Morgan Global Precious Metals desk, right? There's still Citigroup. There's still, UBS, Goldman Sachs, go down the list. So there's money to be made. What they can't have is a 50% year. That'd be catastrophic. I think the best year we've seen, while we've gone from 400 to 2,400 is about 25%, 28% back in 2011. Okay. They can manage 10%, 30%, 50% is a whole other deal. And that gets back to what you mentioned earlier, Dunnigan, about the four heads of different bullion banks, these trading desks, JP Morgan and HSBC, and I can't remember what the other two were, all ran over to Shanghai back from a period of late March into early April. I mean, there's Reuters stories on all four of them. Some of them use the same picture. And that they're just caught in a jam now in silver, in that, we get reported through the CFTC, their gross positions, and and you can compute the net positions every week with the commitment of traders reports. We know from that data as a group how much net short they are. Not even including the producers that are allegedly hedging or selling forward, just what are called the banks, the swap dealing banks. They're currently net short about 40,000 contracts. What, 5,000 ounces a contract? That's $200 million. And you're like, well, wait a second. Every dollar that the price goes up, then that's $200 million in losses. So you think, okay, well, they've got an incentive to keep price in check. But the problem, if they keep their price, the New York price in check, and the Shanghai price keeps going like this, well, now that an arbitrage opportunity develops, and all of a sudden the silver that is backing the exchanges, and all their derivatives and the leverage in there, all of a sudden they risk losing some of that. So it's like, okay, we can either keep the price low to keep our paper short position from, accumulating a couple $1 billion in losses, or we could risk kind of an existential event and have our vaults get drained. And so that's what I mean, kind of a rock and a hard place. Now, one last thing though on that. To you and me, it sounds simple, right? It's like, hey, look, Shanghai last night was trading $36 an ounce. And in the US, it's 32. So a simple arbitrage is you buy in the US and you sell in Shanghai. US price goes up from the buying, the Shanghai price goes down from the selling, and and you close that gap. Well, is $4 enough to make that profitable? Is $4 enough to take the risk? And that's something that when I hear people or read people talking about this potential arbitrage, I think gets left out, because to execute that trade and to close that gap, you have to buy in the West and sell in Shanghai. Okay, well, if you're buying in the West for future delivery in Shanghai, you better be darn sure you can actually get your hands on that metal, much less ship it over there and do everything else, and customs and everything else you got to do to get the metal into China itself. Because otherwise, the other end of this thing is short. So do you want to be, if the COMEX or a bank in New York says, we'll get you this in 90 days, do you want to be left hanging out here short in Shanghai? Right? It's like getting sideways with some of the guys, walking down the street in Newark. I'm thinking about, like a Sopranos episode or something here. I don't want to get sideways with Shanghai at all on this deal. So there's a risk to putting on that ARB, just because I don't think anybody could ever feel comfortable in size, a couple thousand contracts worth, 10 million ounces or something in size, enough to make that ARB worthwhile. And so it just continues to widen and keep going this way. Again, it's a very interesting situation we're in, and not one that many of us really anticipated as the year began.
Do you anticipate a crisis point that would be reached when the physical inventories on the COMEX and the LBMA simply reach a level where they can't sustain this pricing mechanism that's been in play for the last couple of decades?
That's what we've all been. I mean, you mentioned you and I met back in 2013. Heck, we were talking about this back then. This was always part of the rationale for stacking your own physical precious metal, was to get it out of the bankers' hands. Don't let them leverage it. We can all have discussions all day long about how many times 1 ounce is levered. The 1 ounce has 10 claims against it, or 20 claims against it, 100 claims against it. Who knows? But as a way of unlevering or forcing an unlevering of that system and getting to some kind of true price discovery for a physical metal, that's always been, hey, everybody do your part. Buy 100 ounces here, buy a tuba Eagles there, that sort of thing. And that's ultimately what, where is that breaking point? Because I don't think the vaults have to go to zero, right? Because they're not going to go to zero. I don't think you're going to get a report out of the LBMA. We are in desperate need of silver. Please sell us some of yours because we've got commitments and we can't hit the SLV for metal anymore or whatever. Instead is that breaking point that you mentioned, my friend. It's that point at which you get almost like a bank run. this crisis of confidence. Again, think of the global current, at least, precious metals pricing scheme, a little bit like your local bank, right? You go deposit your $1,000 in the bank. They don't just stick it in the vault, man. They make loans. They loan out 900 of it, and they keep enough cash on hand so that you can walk in there and say, hey, I need $1,000 because I'm taking a trip to Vegas. But they don't keep, they're not fully, all of their assets are not fully in the vaults, right? And so what happens with a bank run, like we saw with Silicon Valley Bank or some of these others a year ago, is people lose confidence that they can walk in at any time and get in. And they're like, hey, I want my money now. I don't trust this. They don't trust. At some point, you don't trust that you can get your money out of the bank. And so I'm not going to wait around until, I'm 250th in line, right? And that's a bank run. And that's that tipping point you said. At what point does this hyper-levered Western fractional reserve pricing scheme reach a point of no confidence? And then that's when, they don't have to be at zero. We don't have to have no metal for that to reach that tipping point. We just don't, when will that point be coming? And that's all part of this juggling act that the banks have to manage.
I just can't resist the opportunity here to leverage one of the things you just said, and that's the analogy with the fractional banking system, because so many people still believe, unfortunately, that their deposits in the bank belong to them and that they are there. First of all, that it's money, and secondly, that it's there in the bank, and third of all, that it still belongs to them. There's three assumptions. They're all wrong legally.
Correct.
We've had some rather glorious examples of that. We had a major client who purchased a while back $50 million of U.S. minted gold and silver through Miles Franklin, and it was incredibly eye-opening to see the difficulty that she encountered trying to get her bank to wire her deposits to Miles Franklin as payment. As I understand it, it culminated in her being in a closed room for several hours and having multiple executives of the bank come in and appeal to her to please change her mind, until she finally threatened to bring the banking regulators on them if they didn't release her funds. And it reminded me of when I was a kid and you'd watch Beverly Hillbillies, and Jed Clampett would threaten he was going to pull his money out of the bank, and Mr. Drysdale would have a conniption because he thought that would be the worst thing that would ever happen to his bank, which it probably would. But the greater point is not just an eye-opening about that nothing in the bank is yours, but that the banks themselves are in fact becoming very concerned. And for good reason. Their commercial real estate loans are going belly up. Their bond portfolios are looking horrible, et cetera, et cetera. So I know that's not necessarily your arena of specialization, but any further, beyond just being an analogy, any other cautionary thoughts that you have for people about sitting by and assuming that their deposits in the bank, A, still belong to them, B, are there, and C, will be there that the bank will still be solvent when they need to make a withdrawal?
Yeah, first and foremost, you are a creditor of your bank. Okay, they don't just take your $10,000, put it in an envelope, and put it in a safe and say, "This is Bob's $10,000." It doesn't work that way. That client lady you're talking about. If what'd you say, it was $50 million?
Mm-hmm. Yeah.
Oh my gosh, that's a few multiples above and beyond the FDIC insurance. Mm-hmm. But they've loaned that out, right? So they've got. If it's in treasuries, heck, they probably have $500 or $450 million of treasuries that they bought with that. They could do anything with it. At least they can just loan it out in commercial loans. So they don't have that cash sitting there on hand. And so, yeah, if you need some, then you can show up and they'll get it to you. But they don't. And again, this gets back to that kind of normalcy bias that you and I have talked about before. And this has to do with just about anything. Well, tomorrow will be probably just like yesterday. There's nothing to be worried about. And there aren't stories of people having $1 million in the bank and only getting $200,000 back. There aren't. When there's any of these recent bank failures, the FDIC swoops in, they maybe park the bank, JP Morgan absorbs it or something like that. Or if the bank just goes out of business, they just pay off everybody up to whatever that $250,000 level. So there aren't a lot of stories about people just getting, completely wiped out. And so therefore they think, well, it's really not that big of a risk. But man, when it all begins to accumulate, especially at the regional bank level with their exposure to commercial real estate over the next couple of years, these are very real risks to people's finances that they're just kind of, just whistling along without really being aware of it because, the bank, it's in the bank, it's safe, that kind of thing. And man, it really behooves the individual to understand this better. And you're wise to be pointing it out so people can educate themselves and not get caught with their pants down.
Now, you've been talking quite a bit about silver and the apparent tension that's building that's motivated major bullion bank executives to pay a call on the Shanghai Bank as we see the inventories dwindling on the other exchanges. What about gold? There's been so much interest in gold making new nominal all-time highs against the dollar in the West, and certainly talk of the BRICS plus countries rallying around the need for a settlement method that doesn't rely on, I guess, the U.S. dollar and the U.S. debt market so that they can conduct their business without being punished at the whim of the United States or having to worry about a nation that's exhibiting all the body language of someone who has no intention of paying off their debt in the future, other than perhaps in nominal terms by deflating it down to that worthless currency so you can pay off anything if you can make infinite amounts of it. So thoughts about gold's role and maybe what's driving its recent movement and where you see that heading?
Oh, brother, this is another one of those tomorrow's going to be just like yesterday things, because who's left alive that can Joe Biden maybe that can remember a time when the dollar wasn't the world's reserve currency, right? It just, we're going back to 1944 or 5. All the World War II veterans are all dying off, and so it's like, well, it's always been this way, so it's always going to be this way. No, it's not what history would suggest. And as you point out, there are a couple of things that have happened last couple of years that are like, the term dying by 1,000 cuts kind of thing. These are pretty substantial cuts. Back in March, right after the Ukraine war started, back in March of 2022, the U.S., as a way of sanctioning and punishing Russia, froze their non-domestic foreign currency reserves and kicked them out of the SWIFT system, which is the international payment system that allow you to do business internationally. Thereby kind of making the impression that you better play ball. You don't want to get it doesn't matter what you think, what anybody listening to us thinks about Ukraine and Russia and all that kind of stuff. What matters is what the Russians think in this case. And if they look back and other countries go, let's see here, if we ever get sideways with the U.S., they're just going to kick, and it's inevitable we're going to get sideways with the U.S. because we have our own national interests that we're going to pursue. And at some point, the U.S. is probably going to decide that's counter to the U.S.'s, and therefore they're going to kick us out of SWIFT and seize our foreign currency reserves. So when that happened, that was a real blow to U.S. dollar hegemony, if you will. It doesn't mean it. Obviously, the U.S. dollar is still the most widely used thing in global trade, and by far the largest held item in foreign currency reserves in the world. But it definitely, the events of early 2023 or 2022 it kind of spun the wheel towards getting rid of the dollar, de-dollarization a little bit faster. And so where do we stand now? We've got all this talk about whether the BRICS countries, Brazil, Russia, India, China, South Africa, go down the list, how many BRICS plus, whatever you want to call it, are going to come up with an alternative to the dollar. Not something, it's not because I see this a lot too. It's not like it's binary things. Like one day it's a dollar and one day it's something else. No, it's just it's an alternative. It's competition to the dollar. And if China and Russia and India and, go down the list, have a unit that they can conduct international trade in, that they have confidence in the value of it, not fluctuating up and down 20% in a month, but it stays relatively stable. They have confidence in that unit. They're going to use it. And if by using it, you decrease demand for dollars, right? And your audience is smart. They probably understand the supply and demand. You got supply, you got demand, and where they meet is price. Well, if you increase supply, which is what we're doing day after day, month after month with more and more debt, while at the same time you are decreasing demand by virtue of these alternative currencies, well, then the value of said good falls, the price falls. And that's ultimately what all this means. Boy, that was a long answer, but I think I answered your question. Done again, did I? I think.
You're reminding us that you're an economist, and you gave an economist's answer to a question that's very real to a lot of what we're going to experience in our future. And frankly, I think that recency bias of the past 4 decades plus is something that we all need to come to grips with and realize that we cannot presume that the future looks like the past in that regards. Now, I would say that the destruction of the purchasing power of the dollar started in 1913 with the foundation of the Fed. We're down to whatever you can argue based on how you count it, 98% or 96% destruction of the value of the dollar. So when people ask, when's the dollar going to collapse? It's kind of like, well, when do you want to start counting? Because it's been collapsing since the foundation of the Fed in 1913, and it continues at an accelerating rate. And maybe that leads us into where the macro economy of the world that copper may be hinting at where we're going here. And so if you could look at with us what you're seeing by watching copper and what it's telling you about maybe copper in specific or the macroeconomy and the direction you think that's heading.
I think what has been taking place in copper is more just specific to copper and the pricing scheme, the overall pricing scheme, where we're going to trade, derivatives, futures contracts, and say, this is the price because look at it's on CNBC, rather than the actual trading one for one, the physical for the fiat and back and forth. Copper's a very interesting story because, again, it trades in London, where is the actual physically delivered market. But then you got these derivatives that trade in New York. Well, that sounds kind of familiar, doesn't it? Okay. I have always felt, I can't say this is true. This is my 15 years of watching this stuff. That the daily, not every day, but the price of gold and silver is managed to physical delivery. And what I mean by, let me ask you, you remember the guy Michael Nowak of JP Morgan, who's now currently in federal prison for manipulating? All right, he was the head of the JP Morgan precious metals desk back until whatever it was, 2018. He was also on the board of the LBMA, London Bullion Marketing Association. He's now in jail, actual federal prison, for his role in managing and manipulating the precious metals prices through the JP Morgan desk. All right, so that's kind of think of that as the derivative desk in New York managing the price for the physical desk in London. So London knows where the orders are for physical delivery, and they'll say, they'll alert their trader, the JP Morgan traders in London know this, and so they alert the JP Morgan. I'm just saying, picking JP Morgan as, an easy example. Say, we need price, don't take any lower than this because that's going to hit some orders and physical orders to fill, and we don't have the metal to flow at this level at this point. So therefore, we don't want price going below a certain level today, that sort of thing, or above a certain level, whatever. If that's the case, again, what I'm implying here is a lot of the physical delivery is kind of just in time, if you will. It's not like there's this big stockpile of physical metal and they're like, hey, we just got an order for 2 metric tons. So put it on a truck and drive it. You know what I mean? But there are demands for physical metal. We've seen, the global central bank demand, that sort of thing. All right, anyway, long answer. This is how copper works too. Okay? At least in my impression. So why is all of a sudden copper going crazy? Well, there seems to be a supply issue. You can see it in London where we hit 11 new all-time highs, $11,000 a ton about a week ago. Okay. And on 2,200 pounds in a metric ton. So the COMEX price got to 515 or something like that. New all-time highs. What's going on here? Well, Goldman Sachs, about a year and a half ago, was writing about global copper stockpiles, above ground copper stockpiles going extinct by last summer. And they're writing about, price going to 10,000 a ton and maybe 12,000 a ton. Well, maybe that's starting to happen. I don't know if you saw, maybe some of the people listening will remember this a couple of weeks ago. When copper got above 5, 10, 15, they were talking about a big short squeeze in the COMEX and how maybe they'd have to divert some copper concentrate to New York. It was an article in Bloomberg. They're going to cover for these naked shorts and all this kind of stuff. And I'm like, if copper's in that short of supply that they got to divert, ocean vessels to New York, and COMEX copper isn't really even shipped or stored in New York anyway. But if it's in that short of supply that they're talking about that kind of stuff, maybe they do have an issue. And two things have happened in the last 6 weeks. And there's a point to all this, I promise. Back in the middle of April, the U.S. and the U.K., sanctioned Russia again. Where have we heard that story before? And said COMEX and the LME would no longer accept Russian copper for delivery as a metal source. Aluminum, tin, a couple others too, but copper. The other thing was, if you go back, the largest copper mine in the world is in Panama. It's a big, mainly open pit thing called Cobre Panama. And it produces 1.5% of the world's copper supply. And the new Panamanian government was frustrated by the deal the previous Panamanian government had signed with First Quantum to operate that mine. And so they shut it down. 350,000 metric tons of copper a year taken offline. So all of a sudden, is there no copper? Is that what's going on with price? And so ultimately, why am I telling you this whole story? Because frankly, even though we all invest in silver, and Miles Frank, great place to go to get physical silver as an investment. Silver has more in common in 2024 with copper. There's an investment demand like there is for gold, but silver, by far and away, more use comes from it's an electrical component, right? It's a conductor of electricity, that kind of thing. Green metal. So silver's got more in common with copper. If copper just continues to go through the roof at this point for all these reasons that I've talked about for the last 27 minutes or so, silver's going to play along. Okay. And this whole spread between Shanghai and COMEX is going to continue to widen, and it's going to force the price higher. And so I tell everybody all this just so that as further argument that even though price for silver is at 11-year highs, it's probably going higher. And you want to be regularly accumulating it so that you're buying on dips and you're buying on highs. But the main thing is you're buying because it's probably going higher.
Craig, people who want to follow your work or participate in the community of investors that share insights and so on at TF Metals Report, how do they get involved?
Well, the website is TF Metals Report. And like it says in the little fine print above my figure, since 2010, which, it's a long time ago. We've seen a lot, haven't we? Anyway, I write something every day about, what's going on in the day. I record a podcast every night so that I'm kind of everybody's eyes and ears to the world. The community itself, though, even this weekend's thread, where people have been adding to it for the last, for 2 or 3 days, was just, we had discussions on there from geopolitics, still some stuff about, vaccine injuries and things like that with COVID, and everything else that goes with that. We had a great discussion. This is just right on the main thread about polar shift. And how, there's precedent for in the historical record for that. I mean, it's a fascinating community. So I do a little stuff. The community adds a lot, and it's $15 a month. So it's like a, newspaper subscription, maybe. But, at a time like this, I would argue you need as many independent sources as you can get because, plain to see, the mainstream media and the mainstream financial media are not giving you the full story in regards to just about anything. So you got to educate yourself. You got to stay on top of things. And I think the site, TF Metals Report, does a pretty good job of that.
You're reminding me of two things. One is the interview we did with Brad Harris from FullSpectrumSurvival.com. And the title of that interview was "The Official Warning Will Always Come Too Late." And we're seeing that in many, many areas of our lives. The second was the talk that I gave as a panelist of independent media producers at the Rural Symposium on Natural Resource Investing last year in Boca Raton, Florida, where my contribution was called "It's What You're Not Being Told That Will Hurt You." So anyway, there's a lot that we're not being told, and a lot of what we are being told is also false. So being associated with truth tellers and seeking them out is something we're trying to help the subscribers and viewers of our channel by having you on and others. And so, folks, if you don't want to miss a single episode with Craig or any of our other guests, make sure that you get us on get on our free mailing list by giving us your email address at libertyandfinance.com. Make sure you confirm on your confirming email, and you'll get one email in your inbox per day with all our latest interviews, including every interview with Craig. And make sure you check him out at tfmetalsreport.com. And as always, Craig, just on behalf of all of our viewers, thanks for joining us on Liberty and Finance.
It's always great fun, my friend. I hope you have a great summer, and let's do it again soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 27th through June 3rd, 2024, while supplies last. First, we feature 2023 1-ounce Gold Britannia at just $59 over spot. We also have backdated silver 1-ounce Kangaroos at $3.10 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.